Good morning. This is Larry McMillan with a stock market update on Monday, August 16th, before the market opens. So, the big story is still the developing negative divergence between breadth and a few other internals in the market and the price of the S&P 500, SPX. SPX continues to make new highs. In fact, the last 2 days of last week, it made a new all-time high, while breadth was negative both days. That's a bit unusual. We haven't seen that much lately. We've seen breadth lagging behind, but not quite that obviously. Still, the S&P chart is positive. It's making new highs. Its trend lines are higher. There's support at 4370, which has been tested and held once, or well, actually twice. But there are trend lines higher than that even now that perhaps would indicate that, like say at 4,400, there should be some support as well. So the chart is still positive, other things not so much. The equity-only PutCo ratio remains on a sell signal, although if you look at the charts, you'll see they started to top out or roll over. A local maximum on the PutCo ratio chart would be a buy signal for stocks. So there seems to be a bit of a dichotomy there. In other words, stocks have been performing worse than SPX for, really since about the 1st of July. But now it looks like some of the stocks are starting to do a little better. So the PutCo ratio is seemingly out of sync, but it's in sync with the broad level of stocks. The breadth, as I said, has been negative. Our breadth oscillators are split right now. The stocks only breadth oscillator is on a sell signal. The New York Stock Exchange breadth oscillators on a buy signal, clinging to a buy signal. But the big differential there is cumulative breadth, which is now lagged behind terribly. It's been 44 days since cumulative breadth made a new high, and on 24 of those days, SPX did make a new high. So that's the negative divergence we're talking about. It can last for a while, but it normally precedes a bear market. Typically, the negative divergence on average lasts about 6 months. So there could be quite a ways of grinding ahead of us here. Anyways, new highs versus new lows, that's still on a buy signal, at least as far as the New York Stock Exchange data is concerned. NASDAQ data has turned negative over the last couple of days in this area. But it's the NYSE data that we pay attention to here for signals. VIX has been pretty much in the side of the bulls, stock market bulls, that is. So VIX is dropping to lower lows. That means it's trending lower. That's bullish for stocks. The VIX spike peak buy signal of July 20th is now starting to run out of steam. There's only a little bit time left in that signal. It lasts for 22 trading days. But still, not a negative sign there. The construct of VIX derivatives, volatility derivatives, remains positive for stocks as well. So all in all, it's still a situation where we want to hold a core long position, mostly because of the positivity of the SPX chart. But we're staying very alert because of this negative divergence that seems to be growing, and it's going to get more publicity as it grows. So it's going to mean that when the market does break, it's going to break quickly. In any case, have a great week trading. I invite you to visit our website, and where we cover in our newsletters, we cover all these things on a daily basis.